for my sins, I'll be standing for the session.
Packed room. This is great. There's all the people interested in VC.
Well,
Tweet all your
this
friends.
panel is comprised of venture capitalists, and the purpose of the discussion today is to share our perspectives on InsurTech, questions that will interest you as startups, and some questions which will be of particular interest to insurers. So with that, let me start by asking each panelist to introduce him or herself. Christophe?
So I'm Christophe Reech. I'm the chairman of Odysseus Alternative Venture, which is the private equity arm of my family investment group. We are present, I've been a financier for nearly 30 years, built in the 90s 2 investment banks, one in Germany, the other one in Japan, which I sold respectively to Commerzbank and Salomon Spitz Barney. At the end of the 90s, created a FinTech. It was not called FinTech at that time. It was called just a company. I sold that one to SunGard in 2005. So since 2006, I do manage my own investment, family investment group, if you like. And we are present in private equity tech in particular, which is run by Minh Tran. That stand for him today. He couldn't come to London. We are present also in real estate capital markets as well as financial services in general.
Great. I'm Reshma Sohoni, co-founder and partner at Seedcamp. As it states in our name, we're very much extremely laser focused on seed and pre-seed all across the European footprint. One thing to note kind of differently about us on this panel is we are a generalist investor, so we do everything, InsurTech, FinTech, but also health tech, prop tech, SaaS, enterprise, kind of everything under the sun. We have more than over 300 companies in our portfolio over the last sort of 7-8 years. We are completely Europe focused, and some of the companies you might have heard of or use are in the fintech space, sort of TransferWise, Revolut, Curve, few of those which are billion-dollar worth businesses. Also UiPath, which is a fascinating enterprise business, where we were also first check-in, and then an InsurTech company called WeFox, which tomorrow should have some pretty exciting news that'll help the entire InsurTech space. So we definitely see WeFox as one of the leading contenders to be one of our next biggest companies. But again, we're very much trying to be the first check-in across the European footprint.
Hi everyone, Vica Manos from Anthemis Group. I'm an early stage investor in the company, and I am responsible for running our financial wellness investment vehicle. So invest in super early stage, similar to Reshma. We usually prefer to be first check-in and go all the way up to Series A in FinTech, InsurTech, and health tech. Very interested in any value proposition that has a very strong behavior modification angle, and basically anything that tries to improve the financial and otherwise situation of individuals or small businesses, because we believe that in this day and age, it's not only possible to be profitable and do good, but you'll be profitable because you're doing good. And that's it.
Good morning, everyone. Carl Bauer from EOS Venture Partners. We are a InsurTech specialized venture capital firm out of the US and out of London. Our investors are all insurers. We are focusing more towards Series A and Series B, but the exception confirms the rule. We have no dogma or religion in terms of where we invest and where we don't invest. We prefer B2B and B2B2C. It doesn't mean that we don't like B2C. We're just a bit scared how much it costs in terms of client acquisition journeys. We invest internationally, but we don't invest where we don't have people on the ground through advisory council. We have 21 advisory council members spanning from China to Tel Aviv to Europe to the US, Canada, and probably going to expand into Latin America. So therefore, we are investing internationally, but only on people who can also represent our interests in these markets. We've been operating for 3 years, have made so far 3 investments. We are a venture capital model which is going to do rather less than more investments. We kind of prefer to invest in areas where we can deepen the vertical as well as the horizontal spectrum of our investments, rather than kind of making many more investments and therefore spreading our risk.
Excellent, thank you. And just to add to my introduction, so So Kevin McLoughlin, co-founder of MTech Capital. So we have offices in Santa Monica and London, focus exclusively on InsurTech, including asset management. We have insurance companies exclusively as our investors. We invest in Europe and North America. And we are essentially stage agnostic, but as a practical matter, I think we are focused primarily on kind of Series A, Series B, a little bit of seed capital. Okay. First question to the panelists. Considering the development of various technologies over the last few years and kind of looking forward about where technologies are headed, and thinking about the impact on the industry so far, whether it's machine learning, various applications of AI, IoT, computer vision, chatbots, robo-advice. What technologies do you think are most promising looking forward, and what segments of the insurance industry do you think will be most impacted? So, Christophe.
Okay. So the way we are seeing our investment, and I just want to make a point, we're not spreading ourselves very much. We are actually exactly the opposite from some of the other panelists here, where we are focusing on certain targets and we get involved heavily. And we are present and we put every single power we have to help them to achieve what they have to achieve. So it's a different angle to investment. So the way we are selecting our investments, and in particular in the InsurTech sector, we look at by different type of trends. So for example, we kind of look at the user trend. What is going on in the user trend? There are two main things that we're looking at the moment. And the first one would be anything which is online and digital access to your insurance. It sounds very basic and obvious, but actually, how many of you still buy your insurance with a piece of paper coming home or this kind of stuff? And that is something we're looking actively. Secondly, important and even more important is the insurance as you go, the type of on-usage insurance, which is a new model where some people may think that large insurance companies or insurance companies may think that this is a challenger to their model. We believe actually that this is a new opening for them, and this is a growth opportunity for most of them. So we're looking this very actively. In terms of business trend, which is the second type of trends we're looking for, we're looking very much at anything which is linked to anything robo-advisory, anything basically which is automated. And which generates business on an automated basis, including not necessarily financial models, but actually the back end as well of the process. And finally, we're looking at the tech, of course. And for the tech side, we're looking at big data, we're looking at AI, and these are the areas that we pay attention to. So I think to summarize, we split this in three main categories of trends, and each of them has between 1 and 2 main areas that we're looking at.
Yeah, and I think, as I mentioned, we're quite generalist. We do about 35 investments a year, so we're taking a lot in, and we really let entrepreneurs, founders kind of guide our thinking on where we should be investing. That said, I mean, you take the InsurTech space, and I think given our experience with what we've done in prop tech or FinTech and health tech as well, these are highly controlled markets, right, and highly regulated markets. So one of the things we've seen being very successful to date with FinTech leading the way and then seeping into the other sectors is, if you want to break an industry like that down, systematically, the way we've kind of thought about it is you start at the user end. And I think what's been eye-opening for us is what users are willing to spend out of their pockets. And you see that with, you can charge for a current account before, right? And in terms of banking, and you couldn't charge for most things in sort of generic financial services. And now you have companies like Revolut or TransferWise or Curve, which people are paying a subscription service for. So I mean, it's sort of revolutionary thinking about that. We have health tech companies like Thriva, which allows you to collect blood, send it out for tests. People are paying monthly for that, doing that sort of every quarter test. And it's incredible what the end user will pay for that you would never think about. And I think when you provide a crappy service, as the insurance market has done for generations, you sort of think nobody will pay for this. And I think we're leading with that, is to say people will pay, and because they're getting a great service. So we that's our way of systematically breaking down a sort of strongly held sector like this. And so we start at the user end, and then we go from there. So I think a lot of things around sort of big data, call it ML, AI, blockchain, things like that, we see as critical for infrastructure, but we tend to think there's a real timing element around that, and that'll come over the next sort of 5 to 10 years and really come into circulation in that time. So timing matters a lot, and we kind of lead from the end user standpoint all the way down the tech stack as to think about disruption and how we can participate in that.
Kevin, thinking about the way that you phrased the question also around, what has happened in the past and where do we see it going forward. So we find it interesting that in the first wave of innovation in the insurance space, we saw a lot of effort focused on digitizing, on digital alternative channels. So basically, a lot of focus on removing friction from how existing products are sold and distributed. What we're finding more interesting and exciting in this second wave is more IP-heavy value propositions and a lot more innovation on a product level. So, let me be the third in a row to mention advanced data, science, and AI. These are buzzwords until they work, and then they make magic. So Anthemis have always been thematic-driven investors and hypothesis-based investors. And around insurance, our hypothesis is that the best way to deal with risk is, instead of mitigating the aftermath of a negative event, stop it from happening to begin with. So technology today allows us to leverage new and richer data sets and to be able to do real predictive analytics that then enable preventative measures, be it preventative care in the health and life insurance space, to, value propositions that help you drive safer or help you keep your home more secure, or even help you avoid cyber risk if you're a small, very small enterprise that, cannot afford to have a big IT department that helps you protect there from cyber risk. So we're very excited about that because we also think that this is a win-win situation. Insurees are safer, healthier, and happier because hopefully they're paying lower premiums. And on the other hand, insurance is happier because that means that there are less claims. And we feel that this is quite a pivotal sort of shift in the way that insurance and especially healthcare is functioning, because our bet is that we're moving towards an outcomes-based system in terms of especially health and insurance. So we're very excited to see what else comes through the pipe.
So your question was about the key technologies. So to oversimplify, it's always dangerous to oversimplify, but to oversimplify things, we kind of see three circular kind of technological developments. Ideally, you want to be at the center of this. It's big data, it's IoT, and it's blockchain. These three areas excite us. We recognize that blockchain is probably going to take much longer than what people maybe expect, but ideally, we want to be in the middle of these three circular areas. For us, the holy grail when it comes to insurance technology and the future of insurance technology is ultimately rethinking insurance pricing, rethinking insurance risk selection, and therefore rethinking the entire insurance model, which is basically based today on an actuarial model and on a kind of very structured, quite dated methodology, which doesn't really correspond anymore to how the world is kind of thinking, ticking, collecting data, etc. So what makes us excited is to find businesses and technologies which go to the heart of this kind of revolution of pricing risk and of selecting risk. Ultimately, fast forwarding this, think of an insurance model which actually doesn't use actuarial sciences anymore going forward. It's going to be part of a model which is going to go from the protective or the protection model of what insurance has always been so far in a quite boring and in not a very customer-friendly way into a prevention, but ultimately into a prediction model. And the prediction model and the prevention model is just going to be additive on the back of this AI and on the back of this IoT. We see AI and IoT totally working together. AI is an overused word. There's very little AI, true AI, actually happening in much of the insurance business. If you speak to some real data scientists or Google Ventures, etc., and I don't have the technical background, but they will all say that AI probably is really only existing at its highest form right now in speech recognition and in language recognition, and that all the rest is kind of probably more statistical, playing around in a kind of reasonably sophisticated way. But there's a lot of playing around possibility and potential in the insurance space. So we are looking at investing and cooperating and partnering with very large data sets to validate certain business models. We're currently having a project in the health science and payment providers, some of the world's biggest payment providers in health insurance, who have enormous insights in terms of the background data to certain payments being done. How can you interpret this? What can you learn out of this? How can you project recovery ratios? Which are the better hospitals? Who are the better doctors? Who are the kind of better cohorts of clients in which you want to invest, et cetera, and so forth. IoT, great areas of convergence between health insurance and life insurance, ultimately working hand in hand in order to kind of create a win-win-win. Happy client, happy insurer, happy society, happy governments, happy social services. So that's, in a nutshell, a little bit how our thinking goes. In terms of the blockchain, there is no, we haven't at least found it, there is no investment proposition we've seen so far which perfectly combines blockchain, IoT, and big data. But there are certain areas, certain sub-segments where the add-on of blockchain is becoming an interesting area. We think that blockchain is going to emerge out of micro ecosystems, whether it's a certain health insurance area, whether it's marine insurance where we invested, whether it's, I don't know, scooter insurance or whatever. And out of that, you will have partnerships created within an ecosystem, a blockchain ecosystem, which eventually is going to graduate to some bigger thing. I'm not smart enough to know whether there's going to be a combined consolidated blockchain solution in 10 years or 20 years or 30 years from now. That's not how we think. We think really of blockchain solutions within an ecosystem where friction, speed, transparency, and cost can be minimized.
Excellent. Quick follow-up question. I guess Reshma and Christophe, to some extent, both mentioned kind of the user experience, the user is the starting point. Given that, how do you think about B2B opportunities, where the user is the insurance company?
Yeah, so I guess, again, bringing a generalist view, and you can add to that, I mean, is I think a lot of the SaaS revolution, enterprise revolution we see in other sectors has come from a user perspective of, you know, the employee at a company is obviously a user as well in their real world with their real world services. And I think a lot of that innovation gets brought in, whether it's approved or not. And so I think, you know, as we think about sort of B2B disruption, innovation within InsurTech space, we think of it very similarly to those other sectors. Is that employee is an end user. You know, they'll be part of teams, they'll be part of budgets, and you need to be, you know, you need to provide a level of service and experience interface that they're demanding, and therefore, you know, up that value chain is being demanded. So I think, you know, we've definitely invested in things like customer service experiences. Reinfer is one of our companies that essentially tries to infer context out of complaints and out of different channels coming in. And some of their customers are insurance companies themselves as well, because there are so many channels for any company to try to handle. And what is the customer or end user actually complaining about, and what's the real issue at hand? And the way to service that is just dramatically different today, and the expectations around doing that is different today. So I think, again, that user matters a lot, and we think, we really, we will back the founders who understand that journey, understand that experience, but ultimately, these are much larger budgets, and so we try to understand the difference between an enterprise sale and a SaaS sale, and ensuring, the right team is in place to go after either one of those two opportunities.
As I mentioned, the user trend as well. The way we see the B2B is actually common sense. It happened exactly in the same way with the banks, with the FinTech sector. These large incumbents have a lot of inertia. They just can't move fast enough, and they realize that. So if you think that you're going to do a B2B by talking to the incumbent and they're going to change themselves, that's not going to happen, probably. So the approach is actually, and they know that, they know they need to externalize somehow some of the progress they will make, and that is where InsurTech, all these tech companies are coming in, because they're not growing to destroy a mechanism or to fit in. They are here to move faster, evolve faster, without the legacy. There is always time later on to fit them in again. And this is where the B2B comes in. You need to speak to the insurance companies, because they are the ones who will channel all this progress which are generated somewhere else. So you have to have a sort of two-way thing, where on one side you have the tech and startup building up without any legacies, and on the other side you're building up your channels. At one point these two merge, and that's how we see it.
I have a funny example, actually. So I had my baby recently through the NHS system, and that's becoming digitized, not fast enough though. So my midwife actually was like, here's my phone number, and you can just get me on WhatsApp. It's not really allowed, but let's do that. And she's on there recommending me a bunch of different services, which, you kind of question, is that NHS approved? What happens if something goes wrong? Is my insurance covering that? Is her insurance covering that? So, I mean, people, these are professionals who care a lot about, servicing the patient or whoever it is, and they want to, they see brilliant technologies out there, they want to pull in, and I think, we can't ignore that as companies, as investors.
They're just ahead of their own institution. Yeah. Excellent. Okay. Next question, and this will be of particular interest to startups in the audience. It's difficult for startups to differentiate among venture capital firms. Okay, so money is fungible. For the earlier stage startups, their first kind of institutional experience in raising money will be their Series A. So what do you think startups should be looking for from their VC firms, their VC investors? Vica, do you want to start?
Sure, yeah. I think the first thing that I would advise is to definitely spend time with at least your lead investors. You'll be working with them for a while. Make sure you like each other. I mean, this sounds pretty rudimentary, but make sure you actually enjoy spending hours and hours in the same room. These people will be on your board, and they'll hopefully be there to support you for a very long time. Aside from that, I think, partner with someone that's committed, willing, and able to actually work for you. The reason to have, a well-balanced cap table with good names there is because that's a good opportunity for you as a startup to tap into their network, to benefit from their experience, and as I said earlier, make them work for you, right? On the flip side, and that's probably even more important, it's also key to find patient capital, because the number one complaint that we hear from startups is that they feel pressure by investors that are very eager for the next funding round to take place, for them to see a big valuation uptake, and they're basically focusing on, okay, grow, to a level that the startup might sometimes feel uncomfortable, and that can lead to other problems from, as easy to manage as, just technical debt, just because they didn't have time to do it properly, to things like, issues with monetizing and other bigger, harder to solve problems because of that sort of speed to grow without really thinking strategically. So I think as an investor, probably one of the harder things to do is to not intervene when you feel you want to. So I think the key is make sure that your investors see your vision and are aligned with it, and just talk to each other, I guess.
Okay.
Commonsensical stuff.
Reshma?
Yeah, I think if you're in the InsurTech space, I guess trying to really understand, to add to Vica's point around, do your homework and understand the value add of the different players out there. Ask a ton of questions about what stage of an investor they are, what size of check they write, what stage of the fund they are. So that's actually quite important is, are they at the beginning of deploying their new fund? Are they at the middle of it or at the end of it? I mean, so that will have implications on patience. I think when we're at the beginning of our fund deployment, certainly more patience than at the end of it when we're raising our next one. And also, that company will have a long gestation period. The other thing around also is, again, for InsurTech is, I guess you will have more of a choice of a vertical specialist and vertical knowledge investor versus a generalist like us. And I think, really understand the difference in value those two bring. I think especially for this space, prop tech, and health tech as well, I think it's valuable to have both sets of investors. I think there's some unique experiences we've had being a generalist investor that we can bring to bear on thinking about product and go-to-market and user experiences, and also enterprise sales and inside sales and versus SaaS sales that we can bring around other industries, but incredible expertise with InsurTech specific investors around how do you, what's been the history around selling into whether it's corporates on the one hand or insurance companies on the other hand, and who are the players within those networks, and who are the influencers, and how do those budgets and deployment work, and how does that entire sort of tech stack and delivery stack work, which is not so relevant in photo sharing or other sorts of more light industries as such. So I would say particularly in this space, a combination, it would be fantastic if you can have your plan A. And that's the last bit, is like have a plan A, plan B, plan C around your fundraising. Is plan A is like that ideal cap table you want to have, and then plan C is survival capital.
I'll pause there, actually, just given the importance of this question for startups, just to see if anyone in the audience would like to ask something specific. Please.
Vica, we talked about startup trying to raise fund run anything. Now, what's your view for RB? What do you want to run B? What do you look for?
The question is, what do you look for in a Series B financing?
Go ahead. I feel like I've talked too much, so okay. I'll sound controversial here, but in the market today, and we may perhaps fall off a cliff in the next year or two, I think capital dominates today, and I think it's just true across every industry. So by the time you are at Series B, a couple of things. I mean, I definitely think capital matters a lot, and I think if you find players out there who are willing to help you become the number one, number two player in any particular market, geography, anywhere where you're targeting, that's extremely powerful. Distribution networks matter a lot as well. So I mean, I think at B, you do have a lot of pressures to really, continue a fast-paced growth and reach new levels. So I think key sort of distribution partnerships, channels, especially within InsurTech, will have a massive difference in getting to large population sizes of customer bases. So those two things at that stage matter a lot.
Yeah, I agree with that. And in fact, I would qualify capital more as muscle, and it doesn't necessarily mean only capital. And the way we invest, as I said initially, is we don't spray and pray. We more focused and try to help. And so that's, for us, for example, the selection of who we invest in and who wants us to invest in is natural. It just comes naturally because the way we think is, do we have or do we bring an unfair competitive advantage to the investment? And when I say unfair, it's unfair. Like we invest when we know we can change the game. And that's why we don't spray and pray. It's because we need to be able to focus. So if we know that this particular company, the size of tickets goes with it. We are coming in at low, entry point 500K, but we can ramp it up all the way to 15, 20 million, no problem at all. So for us, it's really important to focus. And when we focus, we know we can bring an unfair competitive advantage, and that is our investment point.
Sorry, if you could just take that one very quickly. That is presumably your first criteria anywhere from stage A.
Well, no, it has to be the right model, it has to be the right team, it has to be the right, all these things that everybody else looked at, of course, because otherwise you can have an unfair competitive advantage in growing goldfish, if you like, but it's not going to help us much. So the point is that we need to find companies which fit with what we want, and once we have that, then we are searching for the unfair competitive advantage.
Quickly, any other follow-up questions from startups? What to look for from VCs? Okay. Next question, and this one is directed more at the insurance companies in the audience. CBI Insights has just reported that partnerships between InsurTechs and insurance companies are now running at about 30 per quarter, covering Europe and the US, North America. Some of these will work out well, lots of them won't work out. What advice would you give to insurers regarding best practice in establishing how to establish a POC exercise or partnership, and then B, kind of how to behave through the implementation phase? Carl, do you want to start there?
Sure. So in our experience, and we speak to about 200 insurance companies in the world, approximately 80 to 90% of pilots fail, of the insurance companies working on innovative InsurTech pilots or POCs or pilots. And that in itself, it sounds high, but actually it's not that shocking because there's just a lot of testing and playing around in terms of what could work and what could not work. And the insurance companies, rightly so, are kind of using many of these InsurTechs in terms of learning and seeing how they can kind of improve internal processes and how they can work better internally. This being said, maybe you can reduce this ratio a little bit, right? Maybe it can be at 70 or 60. I don't think that anything 20 or 30 is realistic. So where the insurance companies and the friction with the startups lie very often in terms of our experience is that both have unrealistic expectations. So the startup, of course, is very small, smart, has certain ideas, doesn't really know how to work with a large institution, which on top of that is very complex in terms of risk management, claims management, regulatory management, etc. And the insurance company has often a unwillingness to kind of get into a riskier business proposition where actually failure is the outcome. And where basically everybody in the organization is kind of trying to cover their and hedge their bets, so to speak, and making life eventually very difficult in order to make this pilot and the POC successful. Where we have seen successful pilots and POCs is insurance companies, first of all, who have, as an entry point, massively simplified the onboarding of InsurTechs. And the onboarding in a kind of very structured industry is kind of complicated. To simplify the onboarding means that you have simplified NDA disclosures, you have simplified system requirements, you have simplified, cloud-based application systems. Everything needs to be simplified. Some companies are very good. Some large companies are absolutely awful at it and kind of suffocate and risk of killing some of these companies before they know it. So that's the starting point. The second mistake we've seen often is that the interaction with the InsurTechs and startups is being too centralized by insurance companies, i.e. headquarters, corporate development, the kind of poor guy or girl who has to kind of look at their overall insurance tech innovation program in terms of integrating, 55 pilots around the world is totally overwhelmed. and it's very difficult to integrate. What really works well in our experience is that if, you know, global multinational insurance company, you know, UK sub, or I don't know, Hong Kong sub or whatever, basically takes under their wing an InsurTech and basically tests the proposition and the pilot in that given market. Because then you have clear ownership, you have clear accountability, you have clear sponsorship, and it's much, much easier to kind of make it work. Where it works even better in our experience, and it's difficult for insurance companies to kind of get to that, but eventually they have to get to that. Ultimately, it's like how Amazon works, is that you actually pick an executive, usually quite a junior executive within the organization, and basically say, hey, we are, you know, there's this InsurTech, we want to rethink pricing in the, you know, I don't know, in the Californian fleet market. Why don't you actually act as the kind of internal CEO and work with this InsurTech and try to make a business out of this? Most large insurance companies kind of, you know, detest that because they want control. They need, you know, control pricing, actuarial, regulatory, capital allocation, etc. But then when that happens, it actually is where you can get the biggest bang out of the buck in terms of really verifying whether this proposition works. So here, you know, just a few comments.
Great.
Just one, please pay for your POCs, insurers. Like, it's really, it's tough to back companies where they're talking to you guys and you're not paying for anything. You're actually killing the startup by not paying, and it just frankly doesn't cost you much to pay, but you're doing yourself a service by doing that.
Yes, absolutely, great point. That's what we always tell the startups in terms of, you know, be proactive, as daunting as it sounds, be proactive in managing also the relationship. You need to get paid. You can't do everything for free. You need to raise your hand in terms of, you know, how to communicate and how to run the internal logistics, and, you know, have the courage of doing that, because otherwise the machine just rolls you over.
Vica, do you have something?
Yeah, when you pay, in addition to that, you also are more committed to it from an insurance point of view. Given the fact that we've run out of time, I think completely agree. In terms of onboarding, I mean, some of the questions there are not even relevant. That's an easy fix. Just change them. Just change it. And the only other thing that I would add is that what helps make the process successful is, in addition to having very clear expectations of what makes a successful POC, also have a plan of, okay, once those are reached, what happens? Because that, like, it's what we call death by 1,000 POCs. Maybe you have a proof of concept, it actually went well, and then there's that lull period of, okay, now we need to figure out what to do with it. Plan that out ahead of time and just continue rolling out whatever solution it is that worked without having to stop in between.
I'm going to add one comment there, and then we'll go to the final question. We'll run through it quickly. From the insurer perspective, you know, entering into a POC is not kind of cost-free, figuratively speaking. Yes, you'll pay something, but your management will spend time and effort in that POC exercise, and that's not to be underestimated. That is a cost to the insurer. And so you have to look at these startups and figure out, is this company going to get financing at the next point that it actually needs it? Because that is a very difficult discussion. You've invested, you know, 5 months into a POC exercise. You see some real progress, some traction between you and the startup's running out of money and is unable to get financing. Then what do you do? So it's a tricky point. Last question. To each of you briefly, if you were going to start an InsurTech yourself today, eat your own cooking, okay, what kind of InsurTech would it be? Christophe?
So I think, well, there are many ideas that can have, but one of them is probably a replication of something we're doing on the real estate side, which aggregating data. A lot of people think that data is something which is very unique, very private, very everything we want. Yes, there are tons of regulations around things, around these data. However, it's feasible to use AI, big data, to actually source huge quantities of data. You talked about it before. And so I would use data in anything. Well, I could use real estate data, which we are already aggregating as we speak, for an insurance business. And I think I would go that direction.
I'd like to skip this, but that said, I'd probably start in health, something in health tech. We definitely believe personalized medicine is absolutely the future, and it's unparalleled opportunity for us as 7 billion people, but also us as investors. So I think I'd start something around that and connect it into the InsurTech space.
If I had an idea, I'd be out there doing it. Instead, I invest in these amazing, brilliant ideas. Now, kidding aside, I think whenever we sit down to talk about what we find exciting in the market, there is just so many things that literally, actually, anecdotally, Anthemis was at first meant to be a startup to tackle something in financial services that we thought was wrong, and just the ideas were so many that we decided to let's instead invest in them, because there's a bunch of smart people out there innovating and disrupting financial services. So yeah, my idea is to invest in 10 others.
Yes, there are many great areas, because ultimately for us InsurTech is just at the beginning. Think InsurTech, think where PayTech was, or credit card tech 10 or 15 years ago, or bank tech was 10 or 15 years ago. So virtually every area is untapped at this stage. I love the SME space, specialized SME. It's a space which is totally underinsured, which has very specific risks, which is less sensitive to pricing, and which is a big universe in virtually every single market, whether you think of smaller markets in the Middle East, big markets in the US, huge markets in China. So, that's a great area. Another area where we think of doing something is the re-emergence of bancassurance. I think the banks are going to rediscover the power and the interest of insurance. The bank knows much more about the customers than insurers. Because they can scan absolutely everything, where you go, what you do, how you spend, etc. Another area which I would love is playing the convergence of life and health insurance, which is going to happen. I'm not sure when, but the first signs are emerging. And it's going to be a very, very powerful model, because if you can help your client living a better life and paying lower insurance and dying later and healthier, etc. and so forth, it has a huge social impact. And just to make the list even longer, cyber insurance. Cyber insurance today is kind of a very interesting, probably somewhat dangerously defined insurance product, because it's more for service than a real insurance cover with some huge silent risk and avalanche risk exposures. But what I love about cyber is actually cyber, and people haven't really totally realized this, cyber is going to be in absolutely everything you do. You take a dentist appointment, you have a cyber risk. You buy car insurance, you have a cyber risk. You buy life insurance, you have a cyber risk. You do absolutely anything you do with IoT, with big data, with whatever, there's a cyber risk. And so this is still the very, very early days in terms of how can you embed broader and deeper cyber cover, cyber services, cyber analytics into, at the end of the day, scary thought, absolutely everything you're going to do in your life.
Excellent. Okay, we are over time. Panelists, thank you very much. We appreciate it, and I hope you enjoyed it.